Let's look at an example to illustrate these principles. In year 1, ACE purchased inventories from a third-party supplier outside of the group for 100 Rand. The 100 Rand represents the cost price of the inventories for ACE. Then ACE sold the same inventories to P for 150 Rand. The 150 Rand represents the selling price for ACE and the cost price for P. In this example, all the inventories are still on hand in P at year end. So the transaction stopped there. It was not sold to a party outside the group. ACE recognized revenue of 150 from a sale to P. P recognized purchases of 150 included in cost of sales from purchases from ACE. This intra-group transaction has to eliminate with the following consolidation journal entry. Debit the revenue of ACE, 150 Rand. Credit the cost of sales of P, 150 Rand. Remember, a consolidation journal entry changes the combined numbers. It happens on group statement level. I am not changing the separate financial statements of P or ACE. Together with that, ACE recognized a gross profit of 50 Rand, which is the difference between the cost price for ACE of 100 Rand and the selling price for ACE of 150 Rand. P has inventories on hand measured at 150 Rand cost price. Based on the principles we've discussed earlier, that inventories is overstated for group statement purposes. They have to be measured in the group at the cost price paid for these inventories to a supplier outside of the group, to a third party. So what needs to happen is that the inventories must only be measured at 100 Rand for group statement purposes. All consolidation journal entries achieves a certain outcome. The outcome we want to achieve now is to get rid of that profit of 50 Rand that was made intra-group and to reduce the overstated inventories to a cost price of 100 Rand. The consolidation journal entry that will give effect to that is as follows. To get rid of the profit, I debit cost of sales. Remember, I'm using the cost of sale line item to achieve the reduction in gross profit. It is the cost of sales of ACE that I debit with 50 Rand. Now I no longer have that gross profit in the group, and I credit the inventories of P with 50. After I've written this consolidation journal entry, I no longer have that profit in the group numbers, and the inventories in the group will be measured at 100 Rand. Year 2. P sold the same inventories that was on hand at the end of year 1 to a third party outside the group for 170 Rand. P therefore made a profit of 20 Rand. The cost price of the inventories for P was 150 Rand and the selling price is 170 Rand. In the trial balance of ACE, the 50 Rand profit made by selling the inventories to P in the prior year has now moved to the retained earnings opening balance of ACE. Remember, my starting point in year 2 is the separate trial balances of ACE and P. I did not eliminate the profit from the separate financial statements of ACE last year. I only eliminated on group statement level. So the retained earnings opening balance of ACE in the trial balance still includes the 50 Rand profit. P no longer has the inventories on hand as it's been sold outside of the group. P made a profit of 20 Rand. That is not the profit for the group. The profit that the group made on this transaction is the 170 Rand selling price to a third party compared to the 100 Rand cost price paid to the third party supplier. So that the profit that can now realize for group statement purposes is 70 Rand. Again, I need to write a consolidation journal entry to achieve a certain outcome. The outcome I want to achieve is to eliminate the 50 Rand still included in the retained earnings opening balance, so that my retained earnings opening balance of the group is equal to the closing retained earnings of the group of the prior year. And I want to recognize a profit of 70 Rand. In my starting point, being the trial balances of P&S, I have a profit of 20 Rand. So to achieve a profit of 70 Rand, I need to bring in an additional profit of 50 Rand. With my starting point having a profit of 20 Rand, adding to that a profit of 50 Rand with the consolidation journal entry, I end up with my required profit of 70 Rand. The consolidation journal entry that will give effect to that is as follows. Debit the retained earnings opening balance of S. A debit to retained earnings will reduce retained earnings and I will get rid of that profit, achieving what I want. I now credit the cost of sales of S to bring that profit back into year 2. Why am I crediting the cost of sales of S and not that of P? Remember, I'm working on combined numbers. What I did in the prior year was to debit the cost of sales of S to get rid of the profit. Now I'm effectively moving that profit out of the retained earnings of S into the profit of the group. So the credit is the cost of sales of S, 50 Rand. The ultimate effect I'm achieving with all my consolidation journal entries over the 2 years is to move the profit made by S of 50 Rand out of year 1 into year 2. So it's the profit of S I'm changing. How am I changing gross profit? By changing cost of sales. In year 1, I had a debit to cost of sales of S to eliminate the 50 Rand. In year 2, I have a credit to cost of sales of S to bring that 50 Rand back. That 50 Rand in year 2 is not included in the profit of P or S. It's included in the retained earnings opening balance of S. I don't want it there. I want it in profit for the year. So I write this consolidation journal entry that moves it.